Okay, let's unpack this. Because imagine you own a massive floating warehouse.
Okay.
Just a giant steel box on the ocean.
Okay.
And a year ago, you're losing millions, just trying to keep the lights on, the crew fed, keeping the bank off your back.
Oh yeah, bleeding cash.
Exactly.
Yeah.
But today, fast forward just 1 year, and the market is completely flipped. Tenants are certainly willing to pay double the daily rent. You have 0 vacancies.
Which is crazy.
It's wild. And you're effectively printing cash. That is the exact situation EuroDry finds itself in right now.
Yeah.
So in this Talk Tickers deep dive, we are looking at their Q2 2026 earnings call. And I mean, the shift in their financial reality is just staggering. We're talking about a company that went from a $3.1 million net loss at this time last year.
Right, which is rough.
To pulling in $6 million in pure net income this quarter.
Right.
EuroDry is the ticker, and this is just a fascinating turnaround.
It really is. I mean, it's a textbook example of how aggressively cyclical the global shipping industry can be. You're looking at a company that was literally taking on water, financially speaking, in 2025.
Right.
And now they're leveraging every single inch of their fleet to capitalize on what looks like a massive structural shift in global trade.
Yeah, and what we want to do today is unpack exactly how they pulled this off. Because for anyone tracking EuroDry or just the shipping sector in general, this isn't just a story about a hot market bailing out a struggling business.
No, not at all.
Right. There's a very specific, deliberate strategy here. We're talking operating leverage, incredible capital discipline, and some really fascinating macroeconomic bets they're making.
Absolutely.
So to see exactly how fast that tidal wave of cash hit their balance sheet, we really just have to look at the gap between their top and bottom line.
Right. The headline numbers.
Yeah. So they brought in $17.7 million in total net revenue for the quarter, which is a massive 57% increase year over year, which is great.
Yeah.
Right?
Yeah. A solid jump.
And this is the crazy part, their adjusted EBITDA.
Precisely. It's your daily rate. And a year ago, EuroDry was only able to charge about $10,000 a day for that rent. Specifically, $10,428.
Okay.
But in the second quarter of 2026, their average TCE across the entire fleet shot up to over $20,000 a day. $20,398 to be exact.
So the top line revenue effectively doubled per ship.
Yes, essentially. But the magic of operating leverage is what happens on the cost side, right? In shipping, your fixed costs are incredibly high.
Sure.
But once you cover them, almost every additional dollar in revenue goes straight to the bottom line.
Okay, let's break down that floor then. What does it actually cost them to put a ship on the water for 24 hours?
Right, so management laid this out very clearly in the call. Their daily cash flow break-in rate is roughly $12,000 per vessel. $11,858 to be precise.
Okay, so just under 12 grand.
Right. And that number includes the actual operating expenses. So the crew, the insurance, the lube oils, the maintenance, plus corporate overhead, and the scheduled interest and principal repayments on their debt.
Got it.
So if they pull in $12,000 a day, they survive, but they don't make a dime of profit.
So a year ago, when they were only charging that $10,400 a day.
They were bleeding out.
Right. Every single day, every single ship was losing roughly $1,500 to $2,000.
Exactly. But what's fascinating here is that in Q2 2026, even with inflation impacting supply chains globally, things getting more expensive, EuroDry actually managed to slightly lower their daily operating expenses.
And I really lowered them?
Yeah, they brought the pure operating cost of running the ships down from roughly $7,500 a day last year to about $7,400 a day this quarter, $7,444.
Oh, wow.
It's a marginal decrease, sure, but it shows incredibly tight cost control by management.
So the floor stayed rock solid at that $12,000 break-even mark.
Yep.
While the ceiling just blew off to over $20,000. That an $8,000 a day margin per ship.
Multiply that across the fleet over 90 days.
Exactly. That completely explains the 5x profit jump. But, to capture that margin, the ships actually have to be working. They have to be out there moving cargo.
Right.
And this is where the execution side of the earnings call really stood out to me. Because they reported exactly 100% operating and commercial utilization for the quarter.
Which is, yeah.
Not a single day of idle time across the entire fleet.
Which is incredibly rare in this industry.
Right.
I mean, to hit 100% means you had 0 mechanical failures that required a ship to stop.
Yeah.
0 days where a vessel was sitting at anchor just waiting for a commercial contract to materialize.
Yeah.
And 0 time spent in dry dock for mandatory maintenance.
Right, and we should probably explain dry docking, because management noted they are already budgeting 17 off-hire days for the second half of the year, mostly for one of their vessels, I think it was the Alexandros,
right,
to go through it.
Yeah, dry docking is basically the maritime equivalent of taking your car in for a massive legally mandated inspection, but it takes weeks.
Okay.
You literally pull the giant ship completely out of the water, you inspect the hull, you clean the propellers, you update systems to meet international maritime regulations.
Sounds expensive.
Oh, it's very expensive. And more importantly, the ship earns 0 revenue while it's sitting there happening.
Right, because it's not carrying anything.
Exactly. So having a quarter where absolutely 0 ships are offline for dry docking or anything else is just a massive tailwind for their earnings.
It was like a perfect alignment of operational efficiency and market timing.
But that brings us to the actual market itself, right?
Right.
Why is the daily rent doubling?
Because the Baltic Dry Index, which tracks the cost of moving major raw materials by sea, was up 78% year over year in the second quarter.
It's a huge spike.
So what is driving that physical demand? What are they actually moving?
Well, the primary driver is the sustained, robust movement of core commodities. We're talking iron ore, grain, and bauxite.
Okay.
The CFO, Anastasios Aslidis, he highlighted that despite all the macroeconomic anxiety in the world right now, talk of recessions and inflation, the physical volume of these materials moving across the oceans is incredibly resilient.
He specifically called out iron ore exports from Australia and Brazil remaining stable, right?
Yes.
Plus, there is a lot of anticipation around the Simandou project ramping up in Guinea, which, for those who don't know, is one of the absolute largest untapped high-grade iron ore deposits in the world.
It's massive. And that's crucial because iron ore is the backbone of global steel production.
Right.
So when you combine that steady iron ore trade with grain shipment holding steady even, despite all the geopolitical tensions in the Middle East and the Black Sea, you just have a very solid baseline of demand for these bulk carriers.
Okay, wait, hold on.
Yeah.
If demand is surging this much and the spot market is paying $20,000 a day,
Right.
Why did management explicitly state on the call that they want to lock in 1-year fixed contracts right now? Because if I'm looking at this as a retail investor and the Baltic Dry Index is up nearly 80%, I'm thinking, let it ride. Right?
Sure.
Why cap your own upside by locking in a fixed rate just as the party's getting started?
It's a really fair question, but it fundamentally comes down to how you survive the maritime shipping cycle over the long term.
Okay.
This is an industry that is famous for spectacular booms and just devastating busts.
Right. We saw that last year.
Exactly. So if we connect this to the bigger picture, management knows that $20,000 a day is significantly above the historical median. Their strategy isn't to perfectly time the absolute top of the market, it's to build a financial fortress.
By establishing a guaranteed baseline of cash flow.
Precisely. If you lock a portion of your fleet into 1-year charters at these high rates, you guarantee that even if the spot market crashes tomorrow, those specific ships will continue to generate massive free cash flow.
Which easily covers that fleet-wide $12,000 break-in.
Exactly. It guarantees your survival.
So they're essentially paying for sleep-at-night insurance by giving up some potential upside.
Yes.
But they aren't locking up the entire fleet, right?
No. And that's where the strategy gets really sophisticated. They're keeping a strategic portion of their vessels exposed to the spot market through what are called index-linked charters.
Meaning the daily rent for those specific ships floats up and down every single day based on the broader market index.
Exactly. So if rates go to $25,000, they capture that. And on top of that, they are using financial derivatives called forward freight agreements, or FFAs, to hedge their bets.
I noticed that in the transcript, they said they sold 2 90-day contracts for the third quarter of 2026 at around $17,100 to $17,250 per day.
Right.
Walk us through how an FFA actually works in practice for a shipping company, because derivatives can confuse people.
Sure. Think of an FFA kind of like a futures contract for a farmer who wants to lock in the price of his corn before the actual harvest.
Okay.
EuroDry is agreeing to a paper contract that settles at roughly $17,000 a day. Now, if the actual physical shipping rates drop to, say, $14,000.
Okay, so the market softens.
Right. If that happens, EuroDry makes a profit on that paper contract, which offsets the lower revenue their physical ships are earning on the water.
Oh, I see. And if rates spike to 25,000?
Then they lose money on the paper contract. But their physical ships are out on the water earning that massive $25,000 a day. So they still come out way ahead overall.
That's smart.
It essentially smooths out the extreme volatility of the spot market. It allows them to capture the upside while rigorously protecting the downside.
Okay, so they have a highly optimized fleet.
Yeah.
They are locking in a revenue floor, and they are generating a massive amount of cash right now.
A lot of cash.
Here's where it gets really interesting. Because usually in shipping, this is the exact moment when executives get greedy.
Oh, totally.
Right. They see the cash piling up on the balance sheet and they immediately go out to the secondhand market to buy more ships, just so they can capture even more of those $20,000 a day rates.
Which is usually a mistake.
Yeah. But EuroDry is actively avoiding what I like to think of as the used car lot.
They really are. Management was very direct about this on the call. They are flat out refusing to buy secondhand tonnage in this current environment.
The data point they dropped to justify this is just wild.
Yeah.
They noted that a 10-year-old Panamax vessel, which, for context, is a mid-sized bulk carrier designed to just barely squeeze through the original locks of the Panama Canal.
Right, hence the name Panamax.
Exactly.
Yeah.
A 10-year-old one of those currently costs about $30.5 million on the secondhand market.
And historically, the median price for that exact same 10-year-old asset is $19.5 million.
That is an $11 million premium.
Yeah.
It's near a 10-year high. And the only reason a 10-year-old ship is commanding that kind of insane premium is because you can buy it, put it on the water tomorrow, and start earning that $20,000 a day immediately.
Right. You are paying purely for immediate cash flow.
But you are severely overpaying for a depreciating asset. I mean, the ship is already a decade old.
Right. And management is demonstrating remarkable capital discipline by just walking away from those deals. They are not taking the bait. Instead of buying old ships at absolute peak prices, they are directing their capital toward a strategic new building program.
Yeah, they have 4 brand new ships on order right now. 2 Ultramaxes delivering in 2027 and 2 Kamsarmaxes delivering in 2028. And the terminology here actually matters, I think, because it points to exactly what kind of trade they're targeting for the future.
It absolutely does. A Kamsarmax, for example, is an 82,000-ton vessel. And it's specifically engineered to be the absolute largest ship that can physically dock at the bauxite export terminals in the port of Kamsar in Guinea.
Which ties perfectly back into that robust bauxite demand they mentioned earlier as a macro driver.
Exactly.
Because bauxite is the primary ore used to make aluminum. And with the global push for electric vehicles and, new grid infrastructure, aluminum demand is incredibly sticky.
It's not going anywhere. And then you have the Ultramaxes, which are slightly smaller, around 60 to 65,000 tons.
Okay.
But they are highly versatile. They actually have their own onboard cranes.
Oh, interesting.
Right, meaning they can load and unload cargo in smaller, less developed ports that might lack major shoreside infrastructure. So they can go almost anywhere.
But the most important detail about all 4 of these new builds is that they are next-generation eco-friendly designs.
Yes, that is credit.
By staggering these deliveries into 2027 and 2028, EuroDry is fundamentally upgrading the fuel efficiency of their fleet right as international environmental regulations are really starting to tighten up.
It is a calculated long-term play, but it's a play that is backed up by what is arguably the most important structural data point in this entire earnings call.
What's that?
The global order book.
Okay, yeah. Let's dive into this because this is the macro mechanism that basically puts a floor under this entire bullish thesis for the stock.
Exactly.
For our listeners, the global order book is simply the percentage of the current existing worldwide fleet that is actively under construction in shipyards right now.
Right. And today, that number stands at just 14.4%.
Which, 14% sounds kind of low just hearing it.
Yeah.
But the context management provided makes it look microscopic. Because back in 2008, before the massive supercycle crash in shipping, the global order book was at 66%.
Right. So think about the mechanics of that. In 2008, for every 3 dry bulk ships currently on the water, 2 more were actively being built in a shipyard somewhere, just getting ready to launch and compete for the exact same cargo.
Wow.
That is a guaranteed recipe for a massive supply glut, which is exactly why Rates eventually crashed and burned so hard back then.
Right. But today, at just 14.4%, the supply side is heavily constrained.
Very much so.
And it's not just because shipping companies are suddenly being disciplined and not ordering ships. There are massive physical bottlenecks, right? Like, if you want to order a dry bulk ship today, you can't just get it tomorrow.
No, not at all. It takes years. Following that 2008 crash, global shipyard capacity consolidated significantly. A lot of yards just went out of business.
Oh, I see.
And today, the premier shipyards, mostly in China and South Korea, they are absolutely packed, but not with dry bulk carriers.
Where are they building?
They are busy building highly complex, high-margin LNG carriers to service the European energy crisis and massive container ships that were ordered during the pandemic boom.
Oh, right.
So dry bulk is essentially at the back of the line.
Plus, you have to add in the technological uncertainty. If you are a shipping CEO right now, you are probably terrified of ordering a vessel with a traditional engine today, only to find out in 5 years that new environmental regulations require your ship to run on green methanol or ammonia, right?
Yeah, absolutely. That regulatory uncertainty is freezing a lot of capital. Nobody wants to buy a $30 million stranded asset.
Exactly.
So while demand is always going to fluctuate based on the global economy, recessions, booms, whatever, the supply side of the equation has a hard ceiling right now. As the CFO noted, that 14.4% order book provides a very strong structural support level for the industry through at least 2026 and well into 2027.
Because there simply aren't enough new ships hitting the water to flood the market and drive rates down. Now, despite this fantastic setup, I mean, we have costs under control. Cash flowing, supply constrained management didn't completely ignore the macroeconomic headwinds.
No, they were pretty balanced.
Yeah, they outlined a few specific geopolitical wildcards that could disrupt this whole upward trajectory.
Right, and the first one they highlighted was the potential for a U.S.-Iran agreement.
Which is super interesting because initially you'd think peace in the Middle East would be uniformly good for trade, right?
Right, and it is in the long run. But in the short term for shipping, it's complicated. If an agreement were to normalize vessel traffic through the Red Sea and the Gulf, you would see an end to the massive rerouting we are seeing today.
Right, because right now ships are sailing all the way around the Cape of Good Hope in South Africa just to avoid conflict zones.
Exactly. And that massive detour burns more fuel and takes much longer, which artificially ties up vessel supply and pushes daily rates higher.
Ah, I get it. So if the Suez Canal and the Red Sea fully reopen, vessels get to their destinations much faster, which effectively increases the global supply of available ships, potentially putting downward pressure on that $20,000 a day rent.
That's the risk. However, as Liz was quick to warn that, quote, implementation risks remain high.
Yeah, geopolitics is never that simple.
Geopolitical agreements are fragile, and fully normalizing global trade routes takes significant time and trust.
The other macro risk they spent time on was the broader economic picture, specifically warning that global disinflation has basically stalled.
Yeah.
They pointed out that the 10-year U.S. Treasury yield had pushed up to around 4.7%. Now, for the average listener, how does a bond yield in Washington impact a dry bulk carrier moving iron ore out of Brazil?
It all connects through the cost of capital. A 4.7% Treasury yield means global interest rates are staying higher for longer. This keeps the US dollar extremely strong relative to other currencies. And because all major global commodities, iron ore, coal, grain, are priced in dollars, a strong dollar makes those raw materials much more expensive for emerging markets to buy in their local currencies.
And if it's more expensive for them to buy, they buy less.
Yeah.
Which means fewer cargoes for EuroDry to actually move.
Precisely. Furthermore, high interest rates choke off easy credit for infrastructure projects worldwide.
Right.
Which slows down economic growth and dampens raw material demand overall. And management said we were already seeing pockets of demand substitution and softening because of this.
We give a really great example of this with global coal trade on the call.
Yeah.
Year to date, coal shipments have actually softened. They tied this directly to weaker demand from major buyers like China and India, compounded by export limitations coming out of Indonesia.
But what's fascinating about the coal market is how fragmented it is. Because while China and India are cooling off, management noted that shifts in Qatar's energy export infrastructure have actually created emerging support for coal shipments going into Japan and South Korea.
It just shows that in shipping, a headwind in one hemisphere can easily be offset by a tailwind in another. Yeah. You really have to look at the entire global board.
You do. So when we step back and look at the whole board for EuroDry right now, we have massive operating leverage driving a 5x increase in profits. We have disciplined capital allocation, actively avoiding overpriced secondhand assets.
Right.
And we have a historically tight global order book providing a structural floor for daily rates.
So what does this all mean? Which brings us to the ultimate question for anyone actually looking at the stock itself, EDRY. What is all this actually worth?
Yeah, the valuation.
This is where the accounting mechanics and the real-world value of these huge steel assets diverge in a very, very stark way. Let's talk about the valuation gap.
Right. So on EuroDry's balance sheet, the accounting book value of their fleet is listed at roughly $160 million.
But book value is just an accounting formula, right? It takes the original purchase price of the ships and subtracts a steady amount of depreciation every single year. It's just a straight line down on a spreadsheet.
Exactly.
It doesn't factor in the current reality that, for example, a 10-year-old ship is currently selling for an $11 million premium in the real world.
Exactly. The accountants say the ships are worth $160 million on paper. But management, looking at current charter rates and independent external appraisals of the vessels, estimates that the actual real-world liquidation value of their fleet, if they sold the ships today, is roughly $240 million.
That is an $80 million discrepancy between what the balance sheet says and what they could theoretically sell the ships for tomorrow morning.
It is a massive gap. And when you adjust the company's net asset value, their NAV, to reflect the true market value of the fleet, management asserts the stock is trading at a, quote, substantial discount to its underlying worth.
And they aren't just complaining about the stock price being too low. They are actively exploiting it.
Oh, absolutely.
If management genuinely believes the stock is artificially cheap compared to the literal steel they own, the most logical thing to do is just buy back their own shares.
Which is exactly what the board just authorized. They reapproved their share repurchase program for another full year. Since August of 2022, they have already deployed $5.8 million to repurchase over 358,000 shares.
It's a highly efficient use of capital.
Yeah.
Instead of overpaying $30 million for an old ship on the secondhand market, they're using their free cash flow to buy fractions of their own high-quality fleet at a steep discount through the stock market.
Right. And you combine that with their debt strategy. They recently signed a $19 million loan facility for one of their vessels, the MV Ekaterini, which allowed them to refinance existing debt and pull roughly $8 million in extra cash liquidity right onto the balance sheet.
So they are building a war chest.
They are. It is a textbook value setup anchored by a macro environment where the supply of competing ships is severely constrained.
But, you know, there is one final incredibly provocative detail hidden in this transcript.
Oh, yeah.
It was mentioned almost in passing by management, but it might actually be the single biggest catalyst for the entire industry over the next 3 to 5 years. And it has to do with the age of the global fleet.
Ah, right. The demographic cliff of global shipping.
Exactly. Management pointed out that 11.8% of the total global dry bulk fleet is currently over 20 years old.
Right. And to put that in perspective for people outside the industry, in the corrosive saltwater environment of ocean freight, 20 years is nearing the absolute end of a vessel's commercially viable life.
Yeah.
The steel is tired, the engines are old, and the maintenance costs just skyrocket at that age.
And critically, these 20-year-old ships were designed and built long before modern environmental regulations were even conceived. They are massive polluters.
Very true.
And we know that the International Maritime Organization is rapidly tightening emissions standards globally. It is becoming financially punishing to operate heavily polluting vessels.
Yes, the carbon taxes and efficiency ratings are getting very strict.
So here's the thought experiment for our listeners. What happens when the cost to retrofit these aging 20-year-old ships to meet new environmental standards actually exceeds their actual value on the market?
They get sent to the scrapyard. Demolition.
Exactly.
Yeah.
So if nearly 12% of the entire world's supply of dry bulk ships is forced into demolition over the next few years, right at the exact moment that EuroDry is taking delivery of their 4 brand new, ultra-efficient, eco-friendly vessels in 2027 and 2028.
You are looking at a potential supply shock that could send daily charter rates into the stratosphere. If 12% of the global fleet just disappears, and the order book is only replacing a fraction of that because shipyards are full, the competition for the remaining high-quality ships will be fierce.
We're already seeing what happens when rates double, right? EuroDry's profits 5x year this quarter.
Right.
If environmental regulations force a mass scrapping of older tonnage, we could be looking at a structural bull market for efficient vessels that lasts for years. It's an incredibly compelling reason to keep a very close eye on how this company navigates the next 24 months.
They really have positioned themselves perfectly at the intersection of tight supply, operational efficiency, and this impending green transition.
It's something to absolutely keep on your radar. Thanks for joining us for this deep dive into EuroDry. We'll catch you next time.